Okay, welcome to our live Black Diamond Mortgage studio recording of VA loans, and the catchy topic is VA loans are better than cash. So I want to dive into that today, and this is being recorded at Black Diamond Mortgage, so you can watch it on playback anytime. I'm going to pack a lot of useful VA content into this presentation, and I hope you find it really valuable. So natural inclination would be that that cannot be true, that a VA offer is better than a cash offer because it's a loan. And so I'm going to dive into that a little bit. We're just going to do a quick illustration. So I want you to imagine a buyer who's going to buy a home, and they are going to buy $1 million home, and one of them has $1 million cash available to spend, and they're going to make a 100% cash offer. And another one is a veteran who served our country, and they have $200,000 cash, but they also have a VA loan eligibility, and they get in a bidding war. Well, it turns out that the veteran has the ability to pay with the available cash that they have $200,000 to $300,000 more because they can borrow 100% with their VA loan. The cash buyer is actually limited to the amount of cash they have in their pocket. So something a lot of people don't think about is in today's competitive market, the veteran buyer can do 100% of the lower of purchase price or appraisal plus whatever cash they want to put down. A cash buyer can only put down the amount of cash that they have in their pocket or available to spend. So right out of the gate, as you start to think, there are ways that the VA loan can actually put somebody in a stronger buying position with the amount of money that they can spend than just a regular cash buyer. So the veteran has served our country, and they've received an entitlement, and that entitlement is the ability to borrow 100% of the purchase price, and there's no strings attached with that. That's a VA benefit. So some veterans are not walking around with $0 in their pocket. They just have the entitlement, and they also have all the other loan products that they have access to. So this VA buyer is stronger than a cash buyer. So when you're thinking about VA, it's important to know that veterans have earned a benefit, and it's really a benefit. So we're going to dive into some of the details that make a VA loan a great loan. So let's talk about some other things. So we've talked about borrowing 100% and being able to pay on top of that, or having options to pay any amount of down payment with a VA loan. They're not just 100% loans. Another thing that comes up a lot, especially in an accelerating real estate market, is sometimes your appraisal doesn't hit the number. Like the home prices are going up quickly. We've ordered an appraisal, and both a cash buyer and a VA buyer may elect an appraisal just to make sure that the home is reasonably worth what's being paid. On a typical appraisal, when you order it and it comes back, you're pretty much stuck with what the value is on the appraisal report. You could go back and argue with the appraiser, but they're typically going to assume that they're the expert and they came up with a good value, and that's what the value is. On VA, it's actually required, and there's a thing called Tidewater. So if you've never heard of Tidewater, and I'm in my 16th year of mortgage, and every time I've mentioned Tidewater to a realtor or a homeowner, they've never heard of it before. So Tidewater is basically, imagine the ocean has gone out and it's coming back, and it's it's not at the level that it's supposed to be at, and the VA has named it that to say, hey, there's this problem coming. So if you've ever lived on a coastal town where it's shallow, when the water goes out, they want to warn everybody that the water is going to come back. It's going to be dangerous. So they named it Tidewater. The idea is the appraiser has got the appraisal on their desk. They're doing their work, and they're about to turn the report in, and they think it's going to come in low. And so rather than just send it out to all the parties, they actually send a Tidewater notice. So they know that they're supposed to hit, let's say it's an $800,000 purchase. The appraiser is working on it, and the appraiser is thinking, I'm going to deliver it at $700,000. Before they send it in, they send Tidewater notice out. That's their requirement as a VA appraiser. And when you get a Tidewater notice, what's cool about it is if the lender hurries up and talks to all the parties involved in the transaction, you have a short window of time to deliver information to the appraiser supporting the higher value that they have to include if it's legitimate before they deliver the report. So if you get a Tidewater notice, and I've seen one of these, we're in Flathead County, Montana, Lake County on the lake, Flathead Lake. We had a lakefront property one time where it was going to come in a little low. You can imagine lakefront property, I mean, it's all over the board. You have people want to be on the lake, it's nice, but what is it? Is it 1.5 million, 1.3 million? You know, it can be hard to agree on that. So we had an appraiser that was going to swing low. They sent out their Tidewater notice, and we notified the realtors. Well, the realtors really believed strongly in the home value that was being under contract. They delivered comps, comparable sales within a reasonable time frame that are reasonably close to the proximity and the type of home. And that appraiser saw that data, was like, okay, I wasn't going to put those in, but now that you've brought them to my attention, they delivered the report on target. So Tidewater was warning, saying, hey, might come in low. This actually gives everybody an opportunity to come in high. Now imagine, since we're doing the class on VA better than cash, if you have a cash buyer who gets a low appraisal, they're fine with it. That means they get to say, hey, it's worth less. Maybe I don't want to pay. But if you have everybody wanting to make this thing happen and there's data to support it, the VA kind of encourages everybody to do a better job when the appraiser is going to come in low. It's like a warning, and everybody gets a shot to respond to the warning. So that's called Tidewater, and it's exclusive to the VA loan. So it's one more reason why the VA loan can be preferable, because rather than get a report and have to go argue with appraisers, the appraisers are required to give everybody a heads up and then work with everybody before delivering the final number, and that's called Tidewater. So another thing that a lot of people don't know about VA, but it's an important detail, is VA borrowers, especially VA borrowers that earn decent paychecks, are typically able to borrow more of a percentage of their income than other loan products. And the reason for that is VA relies heavily on what they call residual income. And so residual income is how much money do you have left after you spend your money every month. So as you make more money, if you can imagine, everybody generally has a reasonable requirement for groceries and buying things that are not part of the home payment. And as a generic way of looking at the world, let's just assume everybody spends the same amount on groceries and health insurance and a few of those things. And let's just say that everybody spends, $1,000 to $2,000 a month on those items. And then the other stuff is their debt payments, like their mortgage and their car payment and whatever. Well, as your income goes up, you don't necessarily need more food, and you don't necessarily need more of those items. So the VA looks at residual income as just the amount that you need after you pay all your bills, like your required bills. So sometimes on a VA loan, you could borrow with a mortgage payment that's as high as like 60% of your income, and they think it's okay as long as you have good credit and a good job, because if a veteran's earned this entitlement and they want to spend that much on their mortgage, they can. All the other loan products out there, once they go up above a certain amount, and it's usually 40 to 50% of their income, that's the ceiling. And it's actually, regulated by the government when they came out with the Dodd-Frank rules on lending. One of them was the debt to income ratio, as a general rule, was 43% was the max, unless you have a special program. And guess what one of the special programs is? The Veterans Administration. They get their own set of rules. So in the VA, the percentage you can borrow against your income is higher than any other loan product. So if you have a buyer out there who's considering all their options and they're VA eligible, the fact is even if they want a certain mortgage payment and a certain purchase price, their capacity is generally higher with VA, and as their income is increasing, their purchase power is increasing even more, because the VA is going to let them spend more as they earn more as a percentage of their income. So they don't use a generic percentage like the other loan products do. So great VA feature, which is basically residual income and high debt to income ratio. Important note about this is not all lenders use the maximum of what the VA offers. So sometimes you'll find a lender is just going to cap all their lending, doesn't matter what loan program it is, at a certain percentage, just so that in their own lending institution they can maintain a certain amount of safety and security as a bank. So as a consumer or as a realtor working with a consumer, in order to achieve those higher thresholds, it's important to see where you're at. And if you're not getting what you think the veteran is entitled to look around, because the lenders don't all do the max expansive VA lending. That's something you have to check lender to lender. They don't have to do it, but the VA enables them to do it. So having a lender that has some options, that's not just simply limited to one bank, is important when you want to exploit these opportunities. So another thing that sometimes people think about VA lending is the VA appraisal might come in lower than the other appraisals, is something that people think about the VA loan program when you survey people. It's actually not true. So recently, Freddie Mac did a survey of a bucket of loans that closed in the United States. So they picked several thousand loans, and they just went through the data and they looked at what was the purchase price, what did the appraisal come in at, and they compared Fannie Mae, Freddie Mac, FHA, VA, and even like local lending institutions. The data showed that the VA hit the purchase price as a higher percentage of the total than all the other loan programs. So everybody's had, in all loan programs, if you've been doing enough business, if you've closed enough transactions, you're gonna have a bad experience with a loan from time to time. For some reason, when it's a VA loan, people are like, see, it's a VA loan. I knew I should have been working with a VA loan. But the data doesn't support that. The data clearly shows that the VA hits the number at a high percent. And if you want to think about why that is, if you ever are struggling on a VA loan and you call the VA Regional Loan Center, so in our market, in the Montana market, that's Denver, there's a regional loan center for the VA. When you call those people that work at the Veterans Administration, they are trying to help the borrower. And it was something I learned early in my career. I had a veteran borrower, and we were having a little bit of trouble with something, and I made the mistake of blaming the VA, and the veteran said, it's not the VA, it's you. And then I had to rethink about it. And I realized, yeah, it is. It's the lender that I'm working with, or the underwriter. When I call the VA, they're like, here's how you get around this problem, and we want to help the veteran. So that's an important detail. And it also is something where the appraisers, the data supports the fact that they're doing this for veterans. They're trying to get them into the home within reason, within reasonable, comparable sales, and those types of things. So another thing to think about with a VA loan that sometimes doesn't get thought about is if you're entering into a contract to buy a home and you hit the purchase price and the seller's excited and then you go into escrow, the next thing you want to think about is, okay, what now what happens? And so when you get ready to buy a home, you're going to go check it out, and then you're going to do some due diligence. You might check on the insurance, and you a lot of times you get a home inspection, various things like this. In my experience, the VA loan creates an environment where the buyer, seller, and the two realtor partners are actually more invested in closing than a cash buyer. And the reason is in my experience, the cash buyer is a little fickle. They're gonna hope for an easy process, and they want a quick process, and they don't want any problems. So what if a problem comes up? Well, what my experience has shown is if you run into a small problem, a cash buyer is more likely just to go move on to another property. The veteran, on the other hand, earned a benefit. They've obviously demonstrated through their service to our country that they're willing to put forth work to get goals accomplished. A few obstacles thrown at a contract that's now hit a purchase price, you have people willing to work through that stuff way more on a VA deal than a cash deal. And so my experience is as long as everybody's willing to meet the requirements, it closes. And you think about it, we don't just want a contract, or we don't just want an almost buy a house. We actually want to close. And if you want to close, what you need is a bunch of people who are all going to work together and achieve a closing. The VA loan tends to produce people willing to do things. Once the sellers accepted a VA offer, they know that there might be a case where if there's like peeling paint on one window on the back corner of the house, that somebody might have to go do that, but they get $1 million. And so maybe it's worth it to do a few things to get the highest and best, because it's really about getting the highest and best. So something to think about is the desire to close is generally higher with a VA buyer. Finally, this might be less of a tangible, data-driven statistic type thing, but the reality is if you have a bunch of buyers to choose from and you're selling a house, and let's just say they all offer the same price. If one of them's a veteran, the fact is they served our country, and you can sell to that person and reward somebody for serving our country. So it's just a simple principle. If you could pick between all the different buyers out there, it's kind of like the local hardware store will occasionally say, hey, we're going to give a discount to all the veterans out there. Thank you for serving our country. Well, if you're selling a home, this is your chance to not just sell your home, but to get the highest and best for your home and to reward a veteran for serving our country. So when you think about the VA loan, if you're representing a seller or you're a seller, it's important to note that they have a great loan that they have access to. And as somebody selling a home, you have the opportunity to reward somebody for that service. So these are the big reasons on why the VA, in my opinion, actually trumps cash, especially when you're talking apples to apples on the purchase price. I wanted to use this time just to address a couple of VA loan myths. So we've kind of demonstrated the VA is a great loan product. There's a lot of misinformation, or to use a popular word now, disinformation, about VA loans out there. So let's talk about VA loans and just things that are real. So a lot of people think that VA loans don't close as easy or as high of a percentage as the other loans. The other loans are your Fannie Mae, Freddie Mac, local bank loan, FHA. The data shows that the VA has a higher close rate for the number of applications taken. And I'm going to drill down onto why that is real quick. So you'd be like, oh, he's just saying that. No, so the VA actually allows a lower credit score. Most loan programs have higher credit thresholds. So right out of the gate, if the borrower applies for a VA loan and their credit's a little bit lower, they're going to be approved at a higher percentage based on their credit score, because the VA works with the veteran to get them a loan because they served our country. Another thing is, I mentioned it earlier, but they do a higher debt to income ratio approval. That leads to more approvals. And then, as we mentioned, the VA is willing to work with the appraisers and whatnot to make the deals happen. Those are the big three things that make up a loan. So on all three fronts, credit, income, and the collateral, the VA has more capacity to approve more loans than any of the other loan programs. So myth, VAs get higher denial rates. Fact, VA loans approved more than any other loan product. Another myth is VA loans are expensive. And typically the word that defines that is there's a thing called the VA funding fee. So a lot of people are, when they see that on a closing document or a settlement statement, like, what is that? That thing is expensive. This is a bad loan. It is all by itself. If all you looked at was one thing, is the fact that there's a thing called a VA funding fee and it doesn't exist on another loan product, then you would be correct to say, hey, that's a fee. Maybe we could look at some other options. But if you look at the total situation, you'll see that the VA over time is actually a lower cost loan. And I'm going to break that down for you. For one, the VA tends to come at a lower interest rate. So over the last several years, the VA has been as much as 1% lower than what a conventional buyer gets for the interest rate. So when that is the case, if you take your VA funding fee, which is anywhere between, if a disabled veteran actually applies for a VA loan, they don't have to absorb the funding fee. But on the other veterans, it'll be anywhere between 1.5 to 3% of the purchase price, and it depends on whether it's a first or second use and some other factors. But when they're doing that, you can just take that interest rate savings and you can extrapolate it over a period of time of the loan and see that the interest rate savings is going to more than cover what they have to pay for the funding fee. But it isn't just the interest rate. It's important to note on the VA loan that there's no monthly mortgage insurance. And it's one of the reasons the funding fee exists. A lot of veteran buyers are using the zero down feature. So you got a zero down loan. No bank's going to offer a zero down loan unless they get some government entity backing it. But if they do, they're going to want that VA backing, and then the VA needs some kind of insurance policy if things don't go right. That's the funding fee. But guess what? No monthly mortgage insurance. So if you look at other products, FHA, conventional, if they're not putting 20% down, they're paying monthly mortgage insurance. They're not on the VA. So if you just take that monthly mortgage insurance and multiply it by many months, you're going to see that the savings is greater than the funding fee. So in total, when you take a VA loan and you look at it over a reasonable period of time, usually we think a reasonable period of time in lending is about 5 to 7 years. The average loan doesn't usually exist more than 5 to 7 years. People make changes, they refinance. But using that window of time and taking the upfront costs and the monthly costs and spreading it out, you're going to actually see that the VA loan is a less expensive loan than the other loan products out there. So myth, VA loans are expensive. Reality, VA loans are a better deal for most people. Another common misconception is that only disadvantaged borrowers are going to use the VA loan. Disadvantage being like credit or no down payment, some of the factors that are benefits of the VA loan. So if I'm looking at VA as an option, as like a seller of a home or a realtor to work with a client, I'm like, oh, this person's going to come with some baggage. They got no down payment or they got low credit. That's also a myth. So if all you know is it's a VA borrower, it's important for you to know that high quality borrowers that have good credit, good jobs, that have earned a VA benefit, they're going to want to use their VA benefit. And I outlined some of those reasons earlier. They have a higher purchase price capacity. They get access to a lower interest rate. So VA doesn't equal low credit and low down payment. Those are just benefits. The reality is any veteran who's served our country has the right to use their VA loan, and they ought to because it's a great loan product. So when you see VA, you want to think of the big picture, which is all borrowers, and a lot of them have amazing credentials and want to use a VA benefit. Another myth about the VA is that, and we kind of have highlighted this a little bit already, but a myth is that FHA or conventional might be better than VA. So as we just talked about, VA gets the lowest rates. VA doesn't have monthly mortgage insurance. VA has a zero down option. We mentioned Tidewater capability. So basically just it's a name myth. VA needs to have, as a person who's serious about closing lots of deals, be it on the realtor side or as a homeowner who's just looking for different loan options, VA is a top tier loan. There's a lot of reasons to like it. Some people think that VA appraisals are slower than regular appraisals. That can be actually debunked. There have been times in history, just like anything, where things haven't worked perfectly, and there have been times in history where the VA appraisal system got backed up or didn't work great. But the realities is all VA appraisers are required to deliver the report in 30 days, and that's not very fast. But that's a legal requirement in order for them to have that VA credential. So they're not going to take any longer than that. During some serious refinance booms, there have been times when other appraisers are even taking longer than that. But more drilled down, like in our market here in Flathead and Lake County, Montana, we used to be down to like 2 or 3 VA appraisers. And when we get high demand, we'd get a little behind. Now they're over 10. So they have plenty of appraisers, and we haven't really seen delays attributed to the fact that it's a VA loan. But additionally, and this is an important detail a lot of people don't know, most appraisals, the appraisal gets ordered and there's a bit of a blind ordering process where the loan officer is not supposed to be working directly with the appraiser. No communication, has to go through somebody else because they're worried about manipulation of value and other things. So there's a little bit of a curtain between talking to the appraiser and just finding out what's going on. The VA is totally different, and it's an important detail. When you order a VA appraiser, you go into the VA benefits portal, you put in the veteran's information, and you say, hey, I got a VA loan application going. You check their eligibility, Once they're eligible, you're allowed to order the appraisal. And you hit a button with all the information in there, and it spits out the appraiser's name and phone number and hands it to the loan officer. And the loan officer can hand it to the realtors and the borrower. So you can just pick up the phone and call the appraiser and say, hey, when are you going to be out there? You know, those kind of questions. These are okay with the VA. It doesn't work as good with the other loan options. So the assumption that the VA appraisal process is anything, you know, substandard or anything like that, it's really not true. You're going to have direct communication with the appraiser if you need it, and you can, and there's more of them now. So the VA appraisals actually work quite well. Another false myth about the VA, and it comes from this one feature that I'm going to discuss, is some people think that the seller has to pay the veteran's closing costs. And they're like, "What? I don't want to pick the VA over that." So there is a thing in the VA rules where the title company day of closing fee can't be charged to the veteran. And a lot of title companies charge like $300 for this. Now, closing costs are everything associated with a loan. So those are not being placed on the seller. It's literally just the day of closing. All the other fees are just on a VA loan like any other loan. And you can actually work with your title company and the realtor partners to just eliminate that, because on a typical transaction, you have realtors earning thousands of dollars, you have title companies earning thousands of dollars, lenders earning, everybody's making pretty good money on a loan transaction. And then there's like a $300 fee. So if you're worried about the one fee, somebody's fine covering it if it isn't the seller. On all the other fees are the same. Now, it is the case that with any loan, that if the seller wants to provide a seller closing cost credit, it's allowed through VA. So sometimes it'll be requested. It's absolutely not a requirement. So fact is, the majority of the closing costs are paid just like any other transaction. And the one that isn't is a very small fee that could be handled by any party in the transaction, if not the veteran. The veteran can't pay the day of closing title company fee. Definitely easy to manage with all the parties to the transaction. Finally, this is another myth, and even veterans have this myth, and so it's important to dispel this myth. And the myth is that the VA loan can only be used one time to buy a primary residence, and then you used it and you don't get to use it anymore. The reality is all you have to do is pay that mortgage off and go get another one, and you can use the VA over and over again. In addition, there are even circumstances where you can have multiple VA loans. So the myth, VA loan is a one-time use. You know, the idea would be you went to war, you came back, and you bought a house, and you got your benefit, and now you used it. Reality is the veterans that are savvy are using the VA loan all the time. They're gaining wealth through real estate. They buy a house with a VA loan, it gets a bunch of equity. They move it into a conventional loan. They go buy another one. They acquire many homes using the VA benefit. If you think about the leverage you could get with 100% financing, and if you could use it over and over again, you could really buy a lot of homes. So when you think of the VA loan, I would think of it more like that. The VA loan is a tool given to a veteran that allows them to acquire some decent real estate. And the market, every time it gives them a little equity, gives them another shot at doing another 100% first, primary residence purchase. So it's probably one of the best ways to acquire wealth through real estate. Those are the big myths, and so we walked through a whole bunch of them. What I want you to think about, and so I'm recording this, there's a couple people in the audience here, so go ahead.
So I've been told by others that there's a loan maximum for.
Oh, good question. So question was brought up about loan maximum, and this is you will, if you're a veteran and you're applying for VA loans, there are lenders that will tell you that there's a loan maximum. So what the VA does is they have kind of a limit that's established in concert with the conventional loans. So in the current market, it's just shy of 650,000 in this part of Montana. And so you will call some lenders offering the VA loan product, and they will say our VA limit is that number, just shy of 650,000. That's a lender imposed limit. So the VA does have two categories of VA. They have a VA jumbo and then a VA conventional. And so some lenders just stop at that conventional, just like they do on their other loan products that are Fannie Mae, Freddie Mac, FHA, they'll have a limit that they impose. So what the VA does is they have a guarantee calculation, and you can actually work with a loan officer or the VA to calculate how much benefit you can use. The important thing to think about is you can buy a multi-million-dollar home with very little to no down payment using a VA loan. So there isn't a loan limit on the VA. It can go millions of dollars. So it's actually another benefit. I'm glad it was brought up. If you're a VA borrower, you are not limited to the loan limit that might be getting bantered around by various lenders. And it's an important thing to, if you're hitting that limit and you need to go over it, it's literally just calling a different lender to solve the problem. There are lenders who use the maximum of what the VA does. Not all of them do, though. I got another question.
With the disability cancels out the funding fee, is that a disability percentage to qualify?
So great question. So the question is, if you can get the funding fee waived and you have a VA disability, how does it get determined? So the main thing to understand is you submit it through the VA. It's not 100% disabled to get the funding fee waived. It's up to the VA. I've seen veterans who are classified as a certain percentage that's less than 100 disabled, and they might be receiving a monthly benefit from the VA and also get their VA funding fee waived. So the important detail is the loan officer cannot complete the process of making the determination, but they have to do what the VA says on the certificate of eligibility. And so your certificate of eligibility tells you what they think at the time of the loan application. A lot of veterans are in process of getting their disability worked out with the VA, and it usually involves doctor visits and, some kind of back and forth with the VA that they make a decision about what you're entitled to. And it can even be done later after years of service. You can go back and say, hey, I didn't realize this. It's been 3 or 4 years. I have this disability, and you can be assessed and determine that you have the disability. So your status with the requirement of the VA funding fee could start out as a standard VA loan where you have to pay the funding fee, and then down the line, if you end up getting the VA to determine that you have a disability, a service-connected disability, you can get that fee dropped on future VA transactions. So main thing would be is if you're aware of it or you're working on it, if you're trying to tie it in with your home purchase, the lender is going to need to see it show up on the certificate of eligibility in order to provide it to you. And so the knowing where you're at in that process helps. But the answer is no, you don't have to be 100% disabled. You just have to be enough for the VA to say no funding fee required. And I do know that it isn't a requirement that you be 100% disabled to get the fee waived. So I'm not sure where the breaking point is, but it's not 100%. So while we're talking about that, VA borrowers who have any disability should always check with the state that they're buying the home in. The property taxes can often be either reduced significantly or waived outright on certain categories of property tax. And there's the organization that we're members of. We have 2 memberships. We're in a group called Vetted VA, where you have to take a bunch of tests to represent veterans in the lending arena through the organization. And we're also in a group called AIM, which is the Association of Independent Mortgage Experts. The AIM group, through the state of Maryland, has just gotten it to be the case that you can use the disabled waiver of property tax in your loan qualification before the state actually offers the discount. So what happens to veterans a lot is they can't prove to the lender that they're going to be out of property taxes because the state that they're in won't look at it until they buy the house. So you got to buy the house, and then you've already got your loan, and so now you're paying property taxes, and then later they reduce the property taxes, and so you weren't able to use that lower tax bill to qualify for more home. So it's been a disadvantage to veterans in that they're trying to buy as much house as they can, and we're having to have a delay in being able to look at the fact that they won't have to pay the property tax. So in Maryland, we just got it passed where now the mortgage underwriters have to consider the fact that they don't have to pay that property tax to approve them for a higher loan amount. And so we're trying to do this nationwide, and so we're using it as a model to get it to go out so that the Veterans Administration would actually push it out to all the states and say, hey, you need to do this for our veterans. So it's in process. It's actually being done by mortgage brokers are the ones making this happen. And we've already succeeded in one state, Maryland, and we're working on others. So in addition to getting the VA funding fee waived, taxes often get waived on property, but unfortunately, currently, that's something you get after you get the house. We're working on getting it to where you can afford more house because everybody knows you're going to get the benefit. So. Well, without any further questions, big picture, we got one more. Go ahead.
Yep. So using the VA loan multiple times, do you have to be your primary residence for 1 year?
So kind of two separate issues. So the question is, does it have to be your primary residence for 1 year? So there's one issue in lending that has to do with occupancy fraud. And basically, you know, the general rule, there's exceptions based on circumstances, but the general rule is if you say you're going to occupy as a primary residence, you do it for a year. Otherwise, you're lying, and you're not really buying primary residence. You're buying investment property. So, as a general rule, if you put it on your loan application and you live in the house for a year, and then after that you go on to another property, you fulfill the minimum obligation to buy a primary residence. So, then move that over to the VA. That would be the same in the sense that it needs to be your primary residence on a VA loan. The exception would be we mentioned that you could have multiple VA loans. So in that case, if you had a home that you owned and you had a VA benefit tied to it, and you could get some of your benefit over to the next home to use the VA loan again, on that next one, it's going to have to be your primary. Obviously, the one that you're not living in anymore is not your primary, but you also don't get as much benefit on the next one. So you're either going to be forced to buy at a lower purchase price or make a down payment to address that. But you might still gain the interest rate and some of the other cool benefits. So bottom line is the 1 year rule is more about occupancy fraud. And then the VA is a primary residence loan as a general rule. So when you take the loan initially, you're always going to be buying as a primary residence. Down the line, if you've got a VA benefit attached to property and you're getting property 2 or 3, you may find yourself with a VA loan attached to an investment property and then use it again on a primary. But each time you use it in the purchase moment, you're buying a primary. Another technical difference is you can buy a multi-unit property with a VA loan. In that case, you're living in one unit, the others are rentals. So that's a primary that you occupy with rentals. So the VA loan can also be used for that. Does that hit at your question?
Absolutely. Is there a limit to how many units you can buy as a multifamily?
So as a general rule, 1 to 4 units kind of, so weirdly in lending, there's like a 1 to 4 unit is kind of under all the regulations that we do business in. Then everything else is what they call commercial. So the easy way to look at it is 1 to 4 unit. We're done. The VA is a cool loan product. So if you find yourself in a situation where you're going to occupy it and it's 5 unit or something, I do believe that there are options to look into. The lender is going to be in a slightly different situation because they have 1 to 4 unit rules that they're living in. And so if you want to get creative like that, the main thing to do is do your homework and know that from the VA's perspective, they're trying to help you have a great opportunity. But you're going to have a hard time working with lenders on it. So 1 to 4 units, pretty standard and easy. Does that make sense? Awesome. Well, I hope what you got out of this was that the VA loan is a great loan, and if you're a realtor looking to expand your business, you should be looking toward veterans, not away from them. And if you're a veteran and you're not sure how valuable the VA loan product is, it's extremely valuable, and honestly, it ought to be your first choice before you rule it out. So work with loan officers that are going to show you how to use that benefit to your advantage. Thank you.